Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business leaders and real estate experts. Past guests include Mark Marquin, Jay Connor talking about raising private money, and Darren Huang, who has 100 units under management and a host of industrial properties. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Listen, Greg, you know how difficult it is to add value to property. Construction's hard, it takes longer than expected, and it's dependent on great vendors doing their jobs really well. At Keyrenter, we line up those dedicated vendors for our owners so they don't have to deal with that headache. And that's why no matter what rental you have, single family homes, condos, townhomes, apartments, we have the management solutions you need. Go to keyrenterpmc.com or email us at info@keyrenterpmc.com. Our guest today is Greg Butcher. He's the managing partner of BluSky Equity Partners, which helps military veterans and patriots multiply and protect their wealth through hands-off real estate investments. He served a career in the Marine Corps and retired in 2015 as a lieutenant colonel. He works primarily with veterans and professional careers who want the returns possible in commercial real estate investing without the headaches of being landlords or the volatility of the stock market. Greg Butcher, welcome to the show. How are you?
Doing fantastic, Matt. Thanks for having me on the show today.
Great to have you. Thank you for your service. We appreciate that.
Oh, absolutely. Thanks for your support.
That is a really funny episode of Curb Your Enthusiasm, if you haven't seen it, where somebody in the show has a daughter that's married to or is getting engaged to a guy that served, and Larry David does not say thank you for your service despite everyone else saying it. It becomes a huge fiasco. So if you haven't seen that, that's really, really funny. Would love to understand for our audience just the broad context of what BluSky Equity Partners does from a 20,000 foot view.
Yeah, basically, I help veterans and patriots. So it's not exclusively veterans, but that's kind of my target audience, so to speak, core group I want to help with. So I help veterans and patriots recession-proof their retirement, get all the benefits of investing in commercial real estate investing without doing all the work and being landlords. So
got it. I love it. And when you say commercial, you're talking exclusively about multifamily real estate, or do you also do some stuff in the mixed use space, in warehouse, and anything else that would be deemed commercial?
Yeah, so far I've only been doing multifamily, although I am looking really hard right now at getting into self-storage at the same time. I figure that self-storage is similar to multifamily, is very recession resistant, and it's a lot of doors under one roof. So
yeah. So in the structure of what you do in the syndicated apartment complex deals, you form the general partnership, and you and I presume some other people, and then investors, veterans and patriots, no flag burners here, veterans and patriots have to form the limited partnership. Is that right?
Yeah, that's correct. So what happens is general partners and limited partners in any syndication, and all the syndication is a group investment. That word confuses some people from hearing more, but all it really is a group investment. So the small number of general partners helps control the deal, helps put together the first place, does the due diligence, takes out the loan and all that, and then helps manage it, usually through a third-party property management company like yourselves there. And then the limited partners, they have none of the work responsibilities or management responsibilities. Their job is strictly limited to deciding if this is a deal that they want to invest in or not. And then if it is, then completing the paperwork and wiring in the funds. And then they kick back and cash checks. And then read the investor reports that we send out every month or not. Totally up to them. So no.
I love it. I say the same thing to our owner. You're welcome to look at the emails that we send. You're welcome to not. Up to you, totally up to you. But correct me if I'm wrong, but limited also speaks to the nature of the downside of that partner. Is that right?
Absolutely. And this is what I tell people when they say, well, why shouldn't I just invest and buy a single family rental instead? I say, hey, you're more than welcome to do that. If you buy a single family rental, for one thing, you're going to have to probably take out a loan unless you have the cash to buy it outright yourself. And so if you take out a loan, then it's your name on that loan. It's on your credit report, and you're on it. If something happens, some weird freak, insurance claim, some kind of weather accident that wasn't covered by your insurance for one reason or another, then you're still responsible for that loan, even if the house is non-habitable. With syndication, your downside is only limited to the amount of your investment. So it is a very, very low downside relatively.
Right. I love it. So ultimately, people can sleep better at night knowing they're not on the hook for their investment, which would be the equity component, the down payment associated with the single family house, and the entirety of the loan. It's just the investment that they've got. And yet they still benefit from the fact that there is leverage on the property. So the appreciation benefit, the fact that the loan is a write-off, some of the depreciation, all the other stuff that you get from investing in real estate, they still benefit from, but they don't have the headache and the potential downside risk associated with the loan.
That's exactly right, because limited partners are not signed on the loan at all. They don't guarantee the loan, so they get like you just said, the cash flow that comes in, the potential for appreciation on the back end, and then the tax benefits throughout also.
I love it. But then in exchange for you taking on all the risk that we just mentioned, you take certain economics on the deal. We don't have to get into the specifics of that, but ultimately you found the deal, you put it all together, you have the banking and lending relationships, you do the management of the asset and overseeing a third-party property manager in many of the cases. And in exchange for all that burden, and as we were talking about before the show, writing those quarterly reports on how the performance on the asset's performance, which I always hated doing personally, in exchange for all that, you take economics on both your money that you put in co-investing alongside the limited partners and the limited partners money.
Yes, that's exactly right. So we typically call that the equity split between the general partners and the limited partners. And there's different ways to structure it. The simple way to describe it briefly would be like a straight split where 80% of the profit from the property goes to the limited partners and 20% goes to the general partners. Because there's a lot fewer general partners. So it ends up being financially very advantageous for us, of course, for all parties of the deal. But yeah, then we also, like you said, we also invest our own money in our deals also as limited partners. So we get the same return on our money we invest as limited partners as anyone else does. Plus then we get that extra slice of the pie for all the management responsibilities that we have from signing the loan. So
for anybody that's never dug into this very deeply, they can skip forward maybe a minute. I'm going to ask a very detailed question. On your documents, do you actually put your money? Do you have a general partnership and that just owns the rights to collect 20% of the equity split, and then you put your limited partner money in directly with the limited partners on the cap table and the LLC documents, or do you actually do like the general partnership puts in capital, your general partnership, and the LP is separate?
No, I think the first way you described that is more how we do it, Matt. So our limited partner money is in there on the cap table just like anyone else's is, and then our general partner general partner shares are typically not for any investment amount; they're for services rendered.
That's exactly how I did it. So the general partnership doesn't own a single asset. The general partnership owns the rights to collect a fee for producing positive results for the limited partnership. Makes sense.
Absolutely.
So there are tons of different real estate strategies. We've talked about single family. You can buy those. You can buy multifamily directly. You can buy mixed use, office, warehouse, farm. People are even in Oklahoma buying cannabis rentals. That's sometimes warehouse, sometimes farm. You can buy vacation rentals. You can be a GP as you are. You can find a GP to hitch your wagon to and be the LP. And there are tons of others that I'm not mentioning. What makes being a limited partner in a syndicated apartment complex acquisition deal stand out for investors in your mind?
Yeah, absolutely. So part of it is being able to do it hands off, like you just talked about, investing passively and getting all those benefits without having to do the work. Another part of it is that multifamily apartment complexes, though it's a very recession-resistant real estate sector. So, and what I mean by that is in good times or in bad times, people always need a place to live. There is a huge shortfall of housing in this country right now. I believe that the stat, and I should have looked this up beforehand, but I didn't. Something like 3 or 4 million worth of apartments need to be built by 2035 to meet all the demand. So there's a huge shortfall. And because of that, there's a huge supply-demand imbalance. And you know how that works with supply and demand. So if there's an excess of demand over supply, then that goes in our favor as apartment investors. It keeps the prices, as high as can be given other economic conditions. And it keeps on, with the ability to achieve rent growth that ends up adding to the bottom line for all the investors.
And I always felt like even if prices were to somehow collapse and that supply stayed the same, but demand dramatically decreased, there's a floor beneath which apartment rentals are not going to go. I mean, they just don't go down to zero. So whereas you might, have an investment in a stock that goes significantly down, you might have a hedged bet on a stock, a put or a call option that could potentially go infinitely against you. Apartments they're so tried and true historically, and they really just don't fall below, they're not going to drop in a worst case scenario in any sort of significant way.
Exactly. And look what happened during COVID, for example. Office kind of dried up. People weren't going into the office. Some places were trying to get out of their leases. Retail kind of dried up at the same time. Apartment demand stayed strong. Our values did not drop during COVID. Some, depending on the quality of the asset, some had a harder time with collecting rents with delinquency because of all the eviction moratorium and all the laws that were put in place there. But if you were in the right assets, that didn't really, and in the right markets, then that didn't really affect you too much either.
Right. So let's talk for a second. If an investor wants to begin to understand the deal flow that BluSky Equity Partners is presenting, how would they do that?
Yeah, absolutely. So I'd say the best thing to do would be to go to our website, which is BluSky. It's BLUSKY, no E in it, but if you put the E in there, it'll still go to the right domain. So BLUSKY-equity.com, and a pop-up will come up that offers a free webinar that we have titled "How to Recession-Proof Your Retirement with Hands-Off Commercial Real Estate Investing." That gives them the short overview of how the deals work, some case studies from some of our past deals, a little bit of history on us, as well as it gives a link to then be able to book a call with us to explore and see where we could possibly benefit and work together in the future.
So if an investor has done all that and they're ready to write a check, they've got to be an accredited investor, as the SEC deems the term. Is that right?
No, not necessarily. And that's one of the beautiful things about all this. There's a couple different ways that we can organize these deals. We do organize our deals in a way where we can only accept accredited investors, but there's another way where we can accept a certain number of non-accredited investors also.
Beautiful.
In our deals. And so we have a large number of investors in our investor club who are working towards getting accredited, but they're not there yet. And this can help them to do so. By offering deals like this, it helps someone who isn't accredited yet makes this same style of investment that used to be only for the ultra wealthy available to the regular middle class folks. And that said, they certainly need to have it's an illiquid investment, so it's not like they can reach in and get their money back anytime. They need to have a safety fund built up aside from this and everything like that. They basically, at the bottom, end of the day, they need to be able to withstand the loss of their money if that was to happen. It's never happened yet, but sometimes some people say there's a first time for everything.
Yeah. What size checks do your limited partners generally write into a deal?
Yeah, so every deal has its own specific minimum, so deal by deal basis, but most often our minimum is $50,000. Sometimes it can be $75,000 or even $100,000. Usually that's the range that I see. Normally I'd say between, we get some $50,000 checks and stuff, but normally it's in that like $75,000 to $150,000 range.
But unlike a venture investment, there wouldn't be like you wouldn't commit $200,000 and have it called $50,000 at a time over 4 years. Whatever somebody were to commit, they would commit upfront and write a check for it. Is that right?
Well, that goes back to how we structure the deal too. So far we've only raised directly for an individual real estate asset, so an individual property. There is a way to organize this as a fund where you're raising money for a fund that invests in multiple assets. And that's attractive to some people too, because that fund is then automatically diversified. And if we raised it through a fund, then we do have that option to have that initial commitment up front and to call those funds in as we get new assets under contract that we want to employ that money into.
Interesting. But heretofore, you haven't done that, but you'd consider doing that in the future?
Absolutely. Yes.
And then theoretically, you could roll over if you were to sell a deal, you could actually roll that capital back in and reinvest it for people if the partnership, if everybody thought it was a good idea.
That's correct. That's one option we don't typically have the ability to do when we're raising for a specific property, unless most of the investors agree up front that, hey, this is going to be something where we're gonna try to do a 1031 exchange as a group when this property sells, so that we can all roll our profits into the next property.
Yeah. Have you ever been able to do that? Roll a sale into a 1031?
We have not yet, but we do have one property where that was the game plan from the start, and we still have that property under management right now. So that is our game plan when this property sells.
Interesting. So knowing that 50,000 is generally the minimum, sometimes 75. If an investor has a limited pool of capital, $100,000, and they're looking at different deals with different general partnerships, different syndicators that are buying apartment complexes, how would this investor decide how to allocate that capital between one or multiple deals, do you think?
Yeah, so it's definitely important to diversify. Even if you have the majority of your wealth in multifamily, there's different ways that you can diversify within multifamily. So one way is, you never want to have all your funds in a single property. That's just, you don't want to do that because the majority of these go great, but every once in a while there's one that might go sideways. So you need to have a portfolio of different investments, even within multifamily, so that the portfolio on average is doing really strong. So you can do that by, I already mentioned, you can invest in a fund where the fund is already invested in multiple assets. You can invest into multiple different offerings that you see. You can diversify geographically, and I definitely recommend that people do that. Oklahoma is a great area. It's my home state, even though I live in Southern California now. Grew up there, and I love investing in Oklahoma and in Texas. But let's face it, you get a lot of wild weather there. So you don't want to have all your assets there and all get hit by the same hailstorm with baseball-sized hail or something like that all at once and have roof damage across your entire portfolio. You can avoid that. You can avoid that by investing in different parts of the country, and there's some great markets in different parts of the country. I'm really big on Arizona personally, and one of the reasons is low insurance costs, because they just don't really have any natural disasters. They don't get tornadoes, they don't get hurricanes, They don't get earthquakes, just the occasional windstorm during the summer monsoon season. So
that's a good point. Just quickly about insurance is that Oklahoma has exorbitant insurance costs because of the number of tornadoes that come through. And just when we had a storm in Oklahoma City and Tulsa that came through on Father's Day weekend, that was like a Class 5 hurricane or a Category 5 hurricane, just demolished the city. It can be terrible, and so that gets built into the actuarials. But sorry, you were going on.
No, absolutely. No, that was really the end of what I was going to say about that. I'll throw in one more. It certainly is possible to diversify by investing with different sponsors as well. That said, if you find a sponsor that you trust and has a good track record, and you have that connection with them, then you may want to choose diversifying through other means. That way too. And if the sponsor is worth their salt, then they'll be helping you to diversify, even if that means not investing in every deal with them.
Do sponsors generally, as they get more successful, take a larger piece of the sponsorship of the equity split?
I mean, it's hard to talk for everyone, Matt, but I do see that on occasion. I think that limited partners or potential limited partners need to be selective on who they're investing with and in what they are taking. I see some newer investors who don't want to invest with anyone who takes an acquisition fee and thinks that if that means that they need to still have a W-2 job at the same time they're doing this, then so be it. They just get I don't know, kind of a scarcity mindset, I guess. And well, they shouldn't be getting anything that I shouldn't get. Well, they're doing the work for the property, and there's so much work that goes into just finding the property in the first place, much less than going through and actually acquiring it and managing it the whole time. So,
and oftentimes those deals, you find one and it falls through, so you've done all this work for nothing. Yeah, and you don't want to have a situation where somebody does a ton of work across multiple deals and then has gotten nothing, and it can be a bad deal.
Yeah, you want the sponsor or general partner to be incentivized to make sure the deal works. So you have to look at the fee structure and everything in the split to make sure that it's actually incentivized. At the same time, you don't want to. There's other choices besides investing with someone who charges an acquisition fee, a refinance fee in the middle, if they refi, and then a disposition fee in the back end, and they're all higher than industry averages. And just fee the property to death. Now those fees aren't charged directly to the limited partner investors. Those are charged to the project, and the limited partner investors, profits and their returns are calculated after removal of those fees. But still, to me, that's just kind of excessive. I've actually I've seen some people do this where they might have instead of if you're doing 3 or 5% acquisition fee, that might be kind of high. A lot of people, the industry standard I see is 2% acquisition fee, but maybe you do a 1% acquisition fee and with a 1% disposition fee in the back end that is tied to hitting certain performance metrics. That's a good way of doing things too, and helps sync up the interests between the general partners and the limited partners.
Yeah, I mean that's a good segue into another question that I have. Is there a potential for misalignment of incentives between general partners and limited partners when making the decision between refinancing to return capital versus selling the asset outright?
There is, but there is naturally going to be, for most projects, I wouldn't say misalignment. It can be impossible to have everyone's interests aligned in one of these syndications. So there might be anywhere from 20 or 30 to a couple hundred limited partner investors in a single syndicated deal. So depending on the size of it. So, getting everyone on the same sheet of music is going to be completely impossible. And that's why, syndicators need to establish up front what their criteria are for exiting and how long they anticipate holding a deal. And potential investors need to be aware of that up front. If someone is wanting to hold on to a property for 10 years or longer as a long-term wealth play, then they probably don't want to invest with someone like me who is really looking at about roughly a 5-year hold period. And the reason I do 5-year hold period is within about 5 years, we can roughly expect to double everyone's investment. And when we get to that point, then it's probably time. That doesn't mean we'll leave right then. That doesn't mean we're going to turn and list it the next day. But it's probably time to start thinking about selling before long, or do a refi, a cash out refi where we can return everyone's investment and hold longer, or a portion of everyone's investment. But our goal is to maximize the IRR to our investors. So it's important that we turn those funds back to them as quickly as we can.
Yeah. And then do you often see that people take the returns from one deal and just plop them into the next syndication?
Yeah, a lot of them do. And there's a tax incentive for them doing so, of course. Everyone gets to benefit from the depreciation benefits throughout the whole lifetime of the property. And that's a big difference between investing in a syndication and investing in a real trust, by the way. And I get that question a lot from people too. Is they typically don't get the tax benefits when you invest in the REITs. Here, we can actually, depending on their tax situation, it can help people shelter, reduce their taxable income, even though they're gaining, income from this. So that's typically when properties. Yeah, exactly. So typically when a property sells, then that in that tax year, there's going to be a depreciation recapture. But we're not taxed based on what happens to a single property that we're invested in. We're taxed based on what happens to us within that tax year. So if you turn around and reinvest in that same year that the property sells, and you get a new round of depreciation coming in from that new invested property, that helps offset the gain from the property that's sold.
I mean, if you just think about it, you take depreciation in the first year of whatever amount, you're taking a benefit to your taxes of 35 or 40%, depending on where you live and all the local taxes. And then if you sell it, though, either way, you're paying long-term capital gains of 20%. So there's still an arbitrage play in that depreciation exercise, in that tax, even if you don't turn around and reinvest that gain to another syndication. You're having your taxable the you would have paid the tax. Beautiful.
Yeah, that's exactly right. And we can amplify that by doing a cost segregation study on the property, which is a lot more cost effective on larger properties, on multifamily properties, versus doing them for single family properties. And all it does is, divide the asset through an engineering study into the items that depreciate over 27 and a half years versus 15 years versus 5 years. And with the bonus depreciation that's available to us right now, we can take a certain amount of all the 5 and a certain amount of the 5 and 15-year depreciation in the year that we purchased the property. That until through last year, we got to claim 100% of that in that same year. Now bonus depreciation is being phased out. So in this year, we only get 80% of it. Next year, it'll be 60% and so on and so forth until it's gone, unless Congress passes a new law about it. So, but that's really powerful. And I know people who have legally paid zero income tax for the last few years because of using bonus depreciation the right way.
So if you have a lot of expected income and some extra cash on hand, and you put it into a syndicated deal, you can really take advantage of that tax arbitrage play.
Yeah, you certainly can. But again, it kind of depends on your tax situation too. So talk to your CPA about it. I'm not a CPA.
Don't play one on TV.
Exactly.
Let's talk some concrete strategies here. I remember when I was syndicating my first apartment complex deal, and we don't do syndications anymore, but I used to. One of my mentors was adamant that we look at the property, that we visit during the rainy season to see how the property dealt with rain. And of course, in Arizona, you're going to deal most of the time, you're going to not deal with that. There was this Burning Man incident recently in Nevada where they got flash flood rains and it screwed everybody up. But generally, you're not going to deal with that in some parts of the country. In Oklahoma, he wanted to make sure that I was aware of how the rain flowed off the property, to make sure that the sewage lines, the storm sewer lines, were appropriately sized and everything else. Unfortunately, it was winter, and I bought it in winter, and I didn't get a chance to visit it during the rain. Spring and summer came, and I realized exactly why he wanted me to do that, because apartments flooded during heavy rains. We had to build some French drains and some retaining walls and insulate some concrete and do some bunch of other stuff. It also helped me realize why the property historically, and even when I sold it, always sold in winter when there wasn't visibility into these sorts of things. But the long story is because I wanted to set up a question for you, which is, without revealing trade secrets that are too deep to your business model and business, what are some items? Can you share some items that over the course of due diligence you can kind of sniff out in properties and make sure you're buying a good property?
Sure, absolutely, Matt. So the drainage is definitely an important facet of things. I remember, it has affected us some at some of my Arizona properties too. One in particular, that just when they do get bad rain, which is not very much of the year, but every now and then it happens. I remember seeing a property that I passed on, largely for this reason. That was in Edmond, Oklahoma, several years ago. That turned out there's a creek right behind it, and there's erosion coming up on the property as I was there. And I was like, oh, okay, I'm not doing this one.
Yeah.
So it starts off, pulling the FEMA flood maps and seeing what kind of flood zone you're in, what's the likelihood, and if you're concerned about the drainage, you can always have an engineer come and inspect. And they can take a look at that based on, the average rainfall in that area. Another thing is just go talk to people that live around there. Not necessarily the residents. That you certainly can when you or the current property manager. They might be tight-lipped, of course, because their current owner is trying to sell the property. But go talk to some of the local business owners nearby or something like that, and or neighbors. And just get a feel for what happens around there. And you never know, you might find an old mechanic or something like that who remembers, oh yeah, I remember that flooded really bad like 3 years ago. So
Smart.
yeah.
Good. That's a good part of due diligence. I never thought about that, but yeah, going around and asking neighbors what they've experienced, and somebody will ultimately divulge the truth and the history of the whole neighborhood, probably.
Yeah, but other than that, for due diligence, I mean, a lot of the physical due diligence, we're getting all the trades out. We're looking at the roof. We're looking at the foundation. We're looking at the HVAC and the plumbing, and we're scoping the plumbing lines and making sure we understand what's going on there. Looking at trees and where roots are compared to the sewer lines and water and plumbing lines. That's a bigger deal in some parts of the country than others, of course. All those things can certainly affect the property. So that's some of the very basic things. And there's on the title side, you're doing a lease audit and understanding what kind of tenants you're inheriting when you first take over the property, and understanding any delinquency in the property and collections or anything like that.
When you're doing due diligence on a property and you're scoping sewer lines and everything else, because you're buying, generally as a philosophy, buying Class B and Class C properties that you want to add value to, I presume that you're okay with some of that stuff. You just want it priced in to the acquisition price. So you would say, I'm okay redoing all these sewer lines, but it's going to cost me $150,000, and therefore I want $200,000 off the price, or whatever it would be. Is that right?
That's exactly correct. We just want to understand what we're inheriting. If we can plan for it from the very start, then that helps us be prepared to deal with it. Maybe we need to increase our CapEx budget, our capital improvement budget, to deal with all the repairs and renovations that we're going to do. Or maybe we approach the seller and request some kind of a credit for it, like you're just talking about there. I've been on, I've done that for multiple properties. So that's exactly how that all works.
What is a bridge too far, and what do you not want to deal with?
What I don't want to deal with is really excess plumbing problems. If it's just too much. I mean, you can if you price it all in correctly. You don't want to deal with. I never want to deal with an older chiller property again, for one thing.
Sure. You and me both. My God.
Yeah, I've done one, and I will not do another.
That's what everybody that buys a chiller property says. Even if you replace the chiller, you still have the hydronic lines that are under the concrete sometimes through the attic that are wearing and thinning and leaking. That's a bad one.
Yeah, exactly. Aluminum wiring is another deal killer for the most part. There are ways to abate it, but you would definitely have to get a seller credit to deal with something like that, because that's going to be significant. Older electrical panels from the 70s. There's a couple different types that tend to
Zinsco.
Yeah, exactly. You know what I'm talking about. Zinsco and Federal Pacific. And that'll make insurance hard to get for the property. So you have to, you could do it, but you have to price that into as a credit from the seller to replace those panels, and those are not inexpensive. And then two, you have to be able to insure the property in the meantime before you get those traded out.
We one time bought a 1920s property that was absolutely beautiful in a syndication deal. And it was a beautiful red brick, historic tiles in the bathroom that we replaced and kept period specific. But they had the old bus fuses, the old round bus fuses. That was problematic because it was so easy. It's different. If you have a 15 amp breaker in a box, it's very difficult for somebody to like go in and replace that fuse. They don't really want to mess with it. But screwing out a bus fuse, a 10 or 20 amp bus fuse, and putting in a 30 amp so that you're overloading circuits and not busting the fuse out, that's very easy to buy on Amazon. It becomes a significant fire hazard. Insurance companies don't like it. We didn't like it. That was a bad one. Sticking on practical suggestions or experience share, I've got an ongoing battle with a business partner of mine. We buy real estate together. He wants to have more equity in the deal so that it cash flows early on. I think we should keep that cash in our pockets, have as little equity in the deal as possible, and then use that cash to buy additional deals. Can you describe from your experience how the typical financing structure of your deals works and how you think about balancing debt versus equity in your deals?
Sure, absolutely. So, because there are multiple passive investors or limited partners in one deal, those might not be in another deal necessarily. So we can't take that equity out and use it for another property. That would be completely illegal. So once we have equity for a property, it stays in that property unless we're returning it to our investors, and that's the way that works. But we typically take out a loan. When I first started this, it was very common to be able to get 75-80% loan to value. Right now, these days, of course, we're in a much more difficult economic climate right now. It was after the Fed's been raising rates for the last year and a half. So right now, typically you'll find loan to values in 60-ish% if you're or somewhere around there, depending on what type of loan that you can take out. The biggest thing is understanding where we're at in the economic cycle, and not wanting to. You don't want to over leverage the property. You don't want to over leverage the property and then have something negative happen where things value drops the other way. And for example, there are syndicators who, over the last couple of years, just before the interest rates dropped, bought some properties that were over leveraged. And then when the interest rates started going up, that has brought pricing down some, because the pricing, the capitalization rates that help determine the pricing is correlated with the interest rates. So that has brought pricing down, and it's possible it could get the pricing level to a point where the lender comes back and says, well, hey, we have to rebalance the loan. You have to come back to the table with an extra $3 million and pay down the loan because the loan is now out of balance. You have too much loan to value now. So that is a possibility, and it's something that no one wants to deal with, because then they might have to go back to their investors and do a capital call where they bring extra money in to bring it into the property. No one wants to have to do that. So getting that right balance of between the loan and the equity is pretty important. These days, I definitely wouldn't go above 70% loan, even if we could. And right now, you're not going to be able to find that with lenders anyway, partially just because of all the volatility the last couple of years. So
I've even heard stories of people that are on 5-year fixed notes, and they're coming back to refinance those notes, and the property values dropped so much, and the pro forma based on a new increased rate has left them so far underwater that they are just walking away from properties and handing keys back to the bank, which is for big buildings, big stuff, probably more in the commercial space in San Francisco and other areas that have been hit really hard on the office segment side, has just been catastrophic. Now bank has a property that they don't want to deal with, and that's all coming down the pike.
Yeah, I've never had anything like that happen, and I certainly don't want to. I want to make sure
for sure
something like that.
The market's been super high lately. It's been hot for a bunch of years. The interest rates, it feels to me, and you may have a different perspective, has not yet induced sellers to bring prices down to where they really need to be to make sense from a cash flow perspective. Maybe that's coming as the tightening continues, the belt continues to tighten from the Fed. How do you approach market timing and understanding real estate cycles, like you mentioned in your last little bit there? Are there specific indicators that you prioritize on when to enter and exit a market?
Yeah, I mean, to a certain point, but to another point, if you plan the deal correctly and structure it right, then it's possible to make money in every market. So I'm never not in acquisition mode, but that said, I'm only right now doing my first deal that I've done in about a year. So it wasn't a plan not to do a deal for a year. It just it happened that way. Didn't find anything that made sense, and the timing just wasn't right. Right now, I think we're actually in a pretty darn good place, and I'm thinking more from a multifamily perspective, so not necessarily for any other asset class. But there has been a price correction in multifamily over the last couple of years. And we're still kind of figuring out where that is. The Fed's interest rate hikes shocked the system because they're so fast, so high. It's never happened before in the history of our country. So that threw the entire market off, and no one, whether lenders, brokers, buyers, sellers, no one knew how to value a property correctly. So there's been a huge buyer-seller disconnect. Buyers, sellers were expecting. So now that the interest rate hikes have slowed down, are they done yet? I don't know. It remains to be seen. But if they're not done yet, then I don't think there's much more to go. And so the slowdown now is allowing buyers and sellers to find that happy medium and come to agreement on where pricing should actually be. So it's still happening. I think pricing may still come down just a little bit more, even though with interest rates are a little bit more stable. But I think we're kind of close to the bottom end of things. So if you have the perspective of wanting to buy low and sell high, I truly believe this is a good time to be doing it, to be getting in the market. You're never going to find the absolute bottom of the market, so don't even try. You can't time it that well. But if you can get into a deal that's maybe a 20% discount from peak market pricing from a year and a half, 2 years ago, then you could stand to do pretty darn good right now. I mentioned before about the supply-demand imbalance for multifamily. So because of that, especially if that's national level, it matters what the supply-demand balance is in that market even more so. But if there's an imbalance in that particular market, then when interest rates start to fall again, even some, they're probably not going to fall like to where they were before. We won't see that again for a long time. But they'll probably fall a little bit. Even the Fed has that in their predictive models. I don't think interest rates will go down to where they were before. And it's never a good idea to try to time the market perfectly. But I do think that right now, when the interest rates drop, the supply-demand imbalance means cap rates will start to fall again too. They'll start to recompress, which drives relative pricing up. So I do think there's ability right now to buy relatively lower and sell for a premium a few years from now.
Yeah, and so for anybody listening, the cap rate is just the inverse of the price to equity ratio. In essence, it's the net operating income divided by the asset value. So in so much as you have more numerator and less denominator, your cap rate moves one way and vice versa.
Exactly.
Wanted to ask one final question. Who is a great mentor of yours that you found early on in the business, and what was the best advice that you got from that mentor?
Oh gosh, now you're putting me on the spot. I've had so many good mentors over the years, to tell you the truth. So I came up in one of the paid mentoring and coaching programs, but it wasn't just him that was a mentor to me. It was all the coaches and the more experienced folks in that group. So I've had so many of them, honestly. Good piece of advice. I think the best piece of advice is to get started now. You can have all the knowledge in the world, and if you don't take action, then it's not doing you any good. You're not going to get anywhere. I've got a saying that action without knowledge is reckless, and knowledge without action is worthless. So, I think it's the best thing. I don't wait to get started just because the market is a little bit scarier right now. As Buffett said, be greedy when people are fearful, and fearful when people are greedy.
I love it. Greg Butcher is the managing partner of BluSky Equity Partners, which helps military veterans and patriots multiply and protect their wealth through hands-off real estate investments. He served a career in the Marine Corps and retired in 2015 as a lieutenant colonel. He works primarily with veterans and professional careers who want returns possible in commercial real estate investing without the headaches of being landlords or the volatility of the stock market. Check out BluSky, that's BLUSKY-equity, BluSkyEquity.com to see the criteria for investments and to start your investment journey. BluSky Equity Partners invest in Phoenix, Tucson, Denver, Oklahoma City, Dallas, Fort Worth, Houston. So they're in a bunch of different markets and can help diversify your investments. Greg, any final words?
Nothing I can think of off the top of my head, Matt. I really appreciate being on the show today, and
this is great.
Thanks a lot. Yeah, always good to connect with a fellow Oklahoma boy.
I love it. Thanks for being on.
Absolutely. Thanks for having me.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.